This is Chapter 18, Public Choice, Taxes, and the Distribution of Income. We're going to talk about public choice, the tax system, tax incidence revisited. We're not going to do too much with that. And then income distribution and poverty. So far, we've seen relatively limited evidence for government interventions in the markets. Governments have been able to reduce deadweight loss or improve economic efficiency by ensuring public goods are provided, regulating markets with few firms, and altering the quantity traded in the presence of externalities. How can we tell what the government should do? For example, choosing between competing public projects and deciding who to tax. We'll review this in this chapter. Public choice. So an important insight of recent research on governmental activities is that government policymakers are people too, rationally interested in themselves, just like consumers and firm managers. They seek to make themselves as well off as possible, which involves increasing their re-election chances. I think about this all the time. If you have this job, it's against human nature to vote in a way that would potentially mean that you would lose your job. So you seek to make yourself as best as possible. The public choice model is a model that applies economic analysis to government decision making and can provide insight into the decisions that governments make. Suppose there's $1 billion available in the budget and Congress must choose whether to spend it only on one of three alternatives: research on breast cancer, subsidy for mass transit, or increased border security. For simplicity, assume there are only 3 voters, with the preferences given in the first one. Lena prefers research for cancer, then mass transit, then border security. David prefers border security first, mass transit third, and cancer research second. And Kathleen prefers cancer research third, mass transit first, and border security second. If these policies came up for pairwise votes and the voters voted accordingly to their preferences, cancer research would beat mass transit would beat border security, and border security would beat cancer research. So there appears to be no way the majority voting to aggregate preferences into a sensible preference ordering for society. And this is kind of what happens all the time when the government votes. This is known as the voting paradox, the failure of majority voting to always result in consistent choices. But it turns out that not only can majority voting fail, so can other voting systems. This result is known as arrow impossibility theorem, a mathematical theorem that holds that no system of voting can be devised that will consistently represent the underlying preference of voters. Since the majority rules is so prevalent, it is important to understand its consequences. One consequence, known as the median voter theorem, is the proposition that the outcome of the majority vote is likely to represent the preference of the voter who is in the political middle. So a lot of times they vote on something, and what ends up happening is either person on the extreme side of the stance wouldn't end up getting their preference. So here's a graph that shows the ideal policies for 5 voters. So spending on breast cancer. So now we're talking about spending money. Kathleen says 0. Jerome says 1 billion. David 2. Then Steve 4, and Lena 6. $2 billion is the preferred policy of the median voter and would beat any other option in a pairwise vote. We have seen previously that markets might fail to achieve the maximum possible surplus for society, but governments might fail in this respect too. We consider 3 ways that governments can fail, and they're called rent-seeking, log-rolling and rational ignorance, and regulatory capture. Rent-seeking refers to attempts by individuals and firms to use government action to make themselves better off at the expense of others. An example, U.S. sugar firms have successfully lobbied the government for a quota on sugar imports, which keeps the price of their product high, which means the consumer loses out on this, but the sugar firm in the U.S. wins because they get to keep the price high and make more profits for themselves. Firms may offer campaign contributions to policymakers in exchange for what is called special interest legislation. This happens all the time. Lobbying, right? Log rolling and rational ignorance. So, log rolling. Politicians gain support for their own proposals by offering support to their colleagues. This is known as log rolling. I'm not sure if any of you have seen the show. Oh no, I'm going to draw a blank. Kevin Spacey. And you can see this happen all the time. House of Cards. This is known as log rolling, and it can help explain why sugar quotas continue to exist even when they benefit very few people. But why wouldn't voters vote out of office people who support inefficient policies? Because most such policies hurt individual voters very little. The loss of surplus per person on a sugar quota is $20. Many voters remain rationally ignorant of such irrelevant ideas. And then we have what is called regulatory capture. In principle, regulatory agencies like the FDA exist to safeguard consumers, but firms that are significantly affected by regulatory agencies have an incentive to make sure the agencies are on their side. The agency which is acting more in the interest of the firm is supposed to regulate, has been subject to what is called regulatory capture. An example, the defunct Interstate Commerce Commission was set up to regulate railroads and trucking firms, but ended up preventing competition in the industry instead. Is government regulation even necessary? The preceding slides paint a grim view of government regulation, perhaps enough to make us wonder, is government regulation just make us all worse off? A recent estimate suggests the cost of federal regulation may be several thousands of dollars per taxpayer. However, agencies do important work in protecting consumers and safeguarding the environment. Economists can help to identify costs and benefits of regulations in order to help policymakers make good choices. Let's take a quick look at our tax system. So, where does the federal government get its revenue sources? This is a graph from 2010. So, as you can see here, 40% of the federal income taxes is raised from social insurances. What is that? Social Security and Medicare tax. Okay? 36.9% is individual income tax, or your federal income tax. 13.6 is corporate tax, and 9.6 is excise and other tax. Just remember that a lot of individuals have small businesses and things like that that will roll onto their individual tax returns. So that's why it's such a larger percentage too. So income tax amounted to $896 billion, and a total amount per household of $7,622, and 36.9%. So this is an idea from 2010. Corporate income are relatively low, as are excise tax, because they're on specific goods like gas. So, state and local government revenue sources. So, state and local governments raise their revenue from different places. So, most of state and local government comes from federal grants and other receipts. So, that's 31%. But then sales tax. So, in Massachusetts, we have sales tax of 6.25%, I believe. And so that sales tax is how Massachusetts raised. And then property tax, individual income tax, other tax, and then corporate tax. An important role of the government is to assure minimum levels of income to needy groups. Social Security pays payments to elderly, retired workers, disabled, widows, and widowers with children. Medicare is a form of medical insurance for the elderly. Medicaid provides health care to the poor. Temporary Assistance for Needy Families, or TANF, provides various forms of financial assistance for a limited time to poor families. The first two programs are administered by the federal government, and the latter two are administered by states, but are federally mandated and funded through federal grants. As a tax is said to be regressive if people with lower incomes pay a higher percentage of their income tax than people with higher incomes. A regressive tax would be an example of Social Security. Progressive tax is the more income you make, the higher percentage you pay, and therefore a progressive tax is our federal income tax. And then taxes that constitute the same percentage for low income and high income earners are called proportional or flat taxes, which is a sales tax, like 6.25% on everything. While some particular taxes are regressive, proportional, and taxes overall in the U.S. are generally progressive situations where the lower income pays a lower percentage. Federal income taxes are progressive, which successfully higher marginal tax rates on income that exceeds certain tax brackets. And next to this is the 2011 tax bracket for a single individual. So we have tax rates of 10 in 2011, 10%, 15%, 25, 28, 33, and 35. Taxes are paid on adjusted gross income, calculated by subtracting exemptions and deductions from your actual income. Assume Matt earns $100,000 AGI. Matt will pay 10% on the first $8,500 and 28% on the last $16,400. So his money is taxed. The $100,000 is divided into each bracket. So it's not that he pays 28% straight across the board. It's on everything between $83,000 and $174,000. So here's the total amount of taxes that he would pay: $8,500 in income, $850 at 10%. 26 at next 26,000, 3,900. Next 49,000, 12,275, and the last 16,400, 4,592, for a total federal income tax on 100,000 of 21,617. Matt's average tax rate. So marginal tax rate is the rate in the bracket. Average is you take total tax and divide by income, or 21.617. Which group pays the most in federal taxes? Are federal taxes truly progressive? The deductions available could conceivably make them not so progressive. So here's a breakdown. The lowest 20% earn 3.77% of income. They pay 0.2% of tax, and all federal tax is a fraction, 0.8%. The second 20%, they earn 8.5%, pay 2.7%, and represent 5.8% of all federal taxes. So the highest 20% of income earners earn 54% of all income tax. They pay 69.7% of federal taxes, and they represent 23% is the average federal tax rate. We can conclude, based on this, basically every bracket pays slightly more than the other one. The highest 1% pays a tax rate of 27.6% average. It's important to distinguish between marginal and average tax rates. Marginal is the fraction of each additional dollar of income tax that must be paid, and average tax rate is total tax paid divided by total income. Economists tend to concentrate on marginal tax rates since they are the most relevant for labor supply decisions. They apply to any additional income that people will earn. Federal government taxes corporations on their earnings via corporate income tax. This is also a progressive tax with the tax rates. Actually, it's more than that now because these are quotes from 2011. The highest tax rate is 39.6% now. Some individuals argue that taxes ought to be assessed at an individual level rather than corporate level because this would avoid double taxation, because the corporations are taxed and then the shareholders of the corporation are taxed on their individual tax return. Another alternative is to tax only at the corporate level, leaving income obtained via investment, capital gains, untaxed. Currently, capital gains are taxed at less than ordinary income in an attempt to offset this double taxation and to spur investment. So here's a list of all the corporate tax rates in 2000 and then 2010. The United States has the highest corporate tax rate. It's now higher than Japan, actually, if we go fast forward. But you can see that we are significantly higher than other countries. And this is why we've heard of corporate inversion, or if you haven't, Google it. It's basically when people are leaving our country to reincorporate in another country because it's lower, especially Ireland. In selecting which taxes to use, the government takes into account the following goals and principles: the goal of economic efficiency, the ability to pay principle, the horizontal equity principle, the benefits received principle, and the goal of attaining social objectives. Each of these suggests different combinations and levels of taxes. Tax literature, deadweight loss resulting from a tax known as an excess burden. An excess burden is a measure of efficiency lost to the economy that results from a tax having reduced the quantity of goods produced, also known as deadweight loss. A desirable feature of a tax system is low amounts of excess burden or deadweight loss. I'm not going to worry too much about this. We're going to skip through here. Should the United States shift from an income tax to a consumption tax? This has been talked about. If the U.S. consumption sales taxes are relatively low and income taxes are relatively high, since those income taxes apply to savings, the effect is tax future consumption more heavily than present consumption. In effect, savings are discouraged by our current income tax system. Many Americans get around this by using tax-deferred savings accounts like a 401k or an IRA. A strike against consumption tax, however, is that these are more regressive, and therefore low-income people end up paying more as a percentage of their income because most of their money is spent on consumption, not savings. There's the idea of the ability to pay principle. The ability to pay principle holds that revenue from taxes ought to mostly be paid by the rich, that is, those who have a higher ability to pay. In practice, this means people with higher incomes end up paying more taxes. This concept is known as vertical equity. Income taxes are progressive, reflecting the ability to pay principle. However, sales taxes are regressive, since consumption constitutes a larger portion of income for the poor than it does the rich. So these go against the ability to pay principle. The horizontal equity principle says that people in the same economic situation ought to pay the same in taxes. This is not easy to apply in practice. If we have two people earning $50,000, horizontal equity seems to suggest taxing each of them the same amount. But if one receives income from a 40-hour-a-week job and the other receives it from a lottery or an annuity, these two people don't seem to be in the same economic situation. Then there's the other idea of the benefits received principle that holds that the government ought to charge more in taxes to people who receive more benefits. Funding locally operated services like snow plowing and road maintenance at the local town level follows the benefits received principle. However, some government services are designed to help poor people. Taxing those people to pay for those services is probably counterproductive. Similarly, it's difficult to identify exactly which groups are helped by what government activities. Example, how would we divide the benefit from national defense? And then there's the goal of attaining social objectives. Taxes are sometimes used to achieve social objectives. For example, alcohol and cigarette taxes are often seen as undesirable for people to consume, so the government taxes these goods relatively highly in order to discourage their consumption. Such taxes are known as sin taxes. I'm not going to cover tax incident, so don't worry about it for the exam. Who really feels the burden? In your book, it talks about who feels the burden of corporate taxes. Well, corporations are not actually people. They are owned by people and sell products to people. So all taxes assessed on corporations are eventually paid by people, whether through lower earnings or higher prices. Taxes on corporate income also discourage investment in corporations, reducing capital available to firms, and hence worker productivity and wages. In fact, the Congressional Budget Office estimates that excess tax burden from corporate income tax may be half as large as the tax revenues generated, making it a very inefficient form of taxation. And finally, we're going to talk about income distribution and poverty. There are always relatively rich and relatively poor people within every society. Whether or not there is a best amount of inequality is an open and very much normative question. More straightforward to ask is, how has the income distribution in the United States changed over time? How do tax systems affect income distribution? And how does income distribution in the United States compare with other countries? First, we will show a table of various brackets in 2009. Without context, it's hard to evaluate. We can achieve some context by considering how they've changed over time. So, the lowest 20% represents 3.7% in 2011, and 1936 it represented 4.1%. The highest 20% represents 54.6%, and in 1936 it represented 51.7%. How many Americans are what we consider quote-unquote poor? And what does poor mean? The federal government defines a household as poor if its annual cash income is below the poverty line, a level of annual income equal to 3 times the amount of money necessary to purchase a minimum quantity of food required for adequate nutrition. The poverty rate is graphed above. According to this is the poverty rate. What percentage of the population? So over time, the percentage of population that are considered poor or below the poverty line has gone down. Decreases in the poverty rate since the 60s came largely from the expansion of Social Security. The table shows poverty rates by general demographics. All people is 15.1%, but 31.6% are female head of household, no husband present. All races, doesn't matter. And then the highest is blacks, followed by Hispanics, Asians, white, and then married couples is the lowest percentage. Rising cost of living and stagnant incomes for the poor are projected to result in increases in poverty over the next few years. In Table 18-6, it shows that income inequality in the United States has been rising over the past few decades. Some factors that help explain this is rapid technology changes has decreased demand for what we considered unskilled workers, and now we need skilled workers. Expanding international trade has had the same effect. Increase in immigration, legal and not legal, has brought unskilled workers to the United States. This has also increased the incomes earned by capital owners, and since capital owners are generally rich, this also increases income inequality. The top marginal tax rate has decreased over the last 50 years. At 1950, it was actually 90%. But it has remained relatively steady for the last 20, as you can see right here. This suggests that changes in marginal tax rates are not the cause of increasing income inequality. The Lorenz curve shows the distribution of income by arraying incomes from the lowest to the highest on the horizontal axis. So this would be a line of perfect equal distribution. This line is the 1980s, and this line is the United States in 2011. A large area between the actual curve and the perfect curve. The larger the area here, the more unequal the incomes are. Income inequality is more concerning if people are permanently poor and or rich. The figure shows the amount of income mobility in a short period of time. Only 69.1% of households who were in the lowest 20% of income in 2004 continued to be in the lowest 20% by 2007. Inequality is also less concerning if the actions of the government reduce the inequality. For example, federal income taxes are progressive, automatically reducing income inequality. Furthermore, transfer payments to individuals like government Social Security and unemployment benefits. The figures we have seen are before tax and transfer payments, so the inequality after tax is substantially smaller. Also, many poor people receive non-cash benefits like SNAP or food stamps, and housing benefits. This further reduces income inequality. There is a substantial debate over how much action the government ought to take in this regard. Around the world, a common measure of inequality is the ratio of income received by the highest 20% earners. This shows the ratio of highest income received by the lowest 20%. America has the highest ratio of any rich nation. Poverty around the world. World standards of poverty are substantially lower in the United States. A common threshold used by development economists is $1 per person per day. By this standard, world poverty has declined significantly over the past few decades. Population in poverty in 1970, now in 2006, the world, 26-5. East Asia, 58-1. These are significant decreases, except for in sub-Saharan Africa. And then common misconceptions to avoid about this. The legal obligation to pay a tax is not the same as who actually bears the burden of the tax. The latter is determined by elasticities of demand and supply. Figures given for inequality are generally before tax transfers. Inequality after these are substantially lower. And that is it for Chapter 18.